Good morning, everybody. Hello, and welcome to another edition of your Bitcoin Economic Calendar, where we cover the news and analysis you need to know for the week ahead in Bitcoin. Today is Monday, December the 14th, and we have lots to cover this week. We had the first ever Bitcoin bond issued last week. We can learn a lot from it and how investors are pricing Bitcoin risk, comparing that bond to other bonds, including corporates and treasuries. We'll be doing that in today's analysis. Additionally, we had the U.S. monetary supply M1 grow by 14% in the last 14 days of November. And with vaccinations around the corner starting this week in the U.S., we're going to pair that with what the vaccinations can do to monetary velocity and how that, combined with the increase in the monetary supply, can impact the markets. And lastly, there's lots of rumors around potential legislation coming out of the U.S. Treasury this week. We're going to talk about what that can mean for Bitcoin and the markets. This and more in today's analysis. So starting our analysis, as we usually do with Bitcoin, we see that Bitcoin started the week in the mid-19,000s. We're just going to zoom out to the daily chart here. And we can see here that we started last week around the mid-19,000s, and essentially we went all the way down to the mid-17,000s levels. And on Wednesday, we caught a bid essentially when Michael Saylor announced that he was raising $400 million in a bond offering to buy Bitcoin through a MicroStrategy's convertible note. Additionally, we also saw that on Thursday, insurance company Massachusetts Mutual Insurance Corporation purchased $100 million of Bitcoin for its investment account. This was announced on Thursday, and it also took a $5 million equity stake in a crypto asset custodian, institutional crypto asset custodian. This news was covered by the Wall Street Journal, so obviously it made the rounds around the investment community. Then finally on Friday, we had Michael Saylor announce that it had closed its convertible bond offering at $650 million, up from the initial $400 million that he had mentioned. And the bond itself had a 0.75% annual coupon. We're going to talk about what this means from a risk perspective in our market trends section today. And we're going to compare this to bonds from other countries and other corporations from a risk management, from a risk standpoint, so that we can see how this compares to how investors are pricing risks elsewhere in the market. Also, we have COVID vaccinations starting this week in the US and also Canada, and this will probably increase the expectation of renewed economic activity, which will increase the expectations of monetary velocity, perhaps accelerating inflation in the US, which bodes well for Bitcoin's current narrative. Separately, just to touch on Mr. Saylor's bond, this idea of borrowing below the perceived cost of inflation to buy an asset that is appreciating at a higher rate is a very compelling concept that may drive others to do the same. You can actually do this by borrowing against your Bitcoin and using your proceeds to buy more Bitcoin. We at Ledden have actually been offering this exact same ability to our clients in one simple step through our B2X product for over a year, and it is our most popular lending product. It's in the back of your screen now if you guys want to check it out. Now, going back to Bitcoin and zoom out back again to the weekly so we can appreciate the weekly move here, which is the last week's move is this little red candle here. All of this added up to Bitcoin closing the week at 19,166, finishing down 1.08%. Now, we are going to cover, again, as I mentioned, what the Bitcoin bond price tells us about Bitcoin risk versus sovereign bonds and similar maturities, as well as some other corporates. Now, moving over to the S&P 500, as we had mentioned last week, was a big week of data for the U.S. Economy and the U.S. dollar, with a lot of it coming out last Thursday. However, the news that stole the show last week, as we can see, the S&P had a down week last week. The news that stole the show on Wednesday was essentially that U.S. regulators and 48 U.S. states filed an antitrust lawsuit against Facebook, accusing it of abusing its power and asking it to divest out of Instagram and WhatsApp. Now, Facebook is a component in both the NASDAQ and the S&P 500, so it did bring down the market when this was announced, as people were concerned about this, or what this could mean for Facebook. So not only did this bring down the S&P 500 and the NASDAQ indices significantly, but investors may start wondering if similar actions may be coming for larger tech stocks such as Google and Amazon, and they are also technology stocks, so we we could potentially be seeing more of this trend continue. Now, additionally, the data that we were mentioning was going to come out last week came out largely or broadly beating expectations. There was a stronger than expected jobs report, and there was higher than expected inflation reading for November. Both of these are good signs that the Fed actions may be steering the economy in the desired direction. Now, lastly, we're going to come out of the chart here for a second because we want to talk about a development that went largely unnoticed last week, which was that on December 10th, the U.S. Federal Reserve released the M1 monetary supply data for the period November 16th to November 30th. This shows an increase in the M1 money supply of the United States of $809 billion in those 14 days. That's 14% in 14 days. To give you some more context, the M1, as we can see here, is currently sitting at $6,542 billion, and we can see that just the 14 days prior, it was at $5,733 million. That is a very, very significant increase, and you can see that it had taken a lot to go from 4 to essentially 6, and now basically from 6 to 6.5, it was very much in days. So that, with vaccinations just around the corner, like, we want to contrast this with monetary velocity, because inflation is essentially a combination of how much money is out there and how quickly is that money exchanging hands. This M1 is how much money is out there. The how quickly is exchanging hands is the monetary velocity. So as we can see, this has been seriously depressed because of COVID. The economic activity is very much suppressed. But with vaccinations around the corner, we can expect this likely to go higher, driving pressures for inflation upwards in the United States. So just going back to the S&P, we see that it had a down week last week. Seems like it's on a track for has a good start for this coming week. But like we mentioned, there's a lot of news flow coming out this week, so we will be monitoring that closely and sharing any relevant info. Now, moving over to gold, we see that it ended the week almost entirely flat, even in the backdrop of signs of inflation for the US dollar. Now, although this seems to reflect that the risk-on narrative is picking up more steam in the investment community, this may favor inflation, but that expectation may have already been priced into gold prices, having rallied 25% from March. So investors may be looking to essentially, or maybe more open to rotating back into industrial or energy sectors that may benefit more from an economic rebound and renewed stimulus spending. With insurance companies now in the Bitcoin mix, it does look like most circles in the institutional investor community have bought into this concept of Bitcoin as an inflation hedge, which can bode very well for Bitcoin prices going forward. Separately, as we've been stating in previous issues, it does feel that Bitcoin is starting to take a lot of the inflation hedging interest away from gold. And with so many high-profile investors joining the Bitcoin club, it starts to become risky not to have exposure to Bitcoin if you own any gold in a managed portfolio. Now, moving over to the DeFi Ftx Index, we see that it performs significantly worse than the protocol levels. We saw that, seeing that DeFi Index had a down week, down 5.31%, comparing that to Ethereum, which was only down 2%, and Bitcoin, which was only down 1%. Going back to this, so we see that the DeFi index was down significantly more than the protocol levels, which is consistent with the observation we had made last week, which was that the price action of DeFi last week, where it outperformed both protocol levels to the upside, may have been driven as more of a short covering rally. The institutional attention seems to be focused squarely on Bitcoin recently, and DeFi will likely continue to underperform the protocol level assets on a relative basis. So in today's market trends sections, we're going to talk about MicroStrategy's $650 million Bitcoin bond, the first Bitcoin bond ever to be offered. And that can actually tell us a lot. We can learn a lot from it and how investors are pricing risk. So Let's talk about that for a second. So as we mentioned, this is the first time institutional investors have essentially been given an opportunity to price Bitcoin risk through an instrument like a bond. While the bond has not yet started trading in the open market and we cannot properly compute its effective yield, for that we need essentially a secondary market trade. We do have very important data points, namely the interest rate that was offered and the fact that the offering started at $400 million, but the note ended up closing at $650 million, meaning that there was much more demand than was originally anticipated. So to start evaluating some of the insights here, let's try to compare this MicroStrategy $650 million Bitcoin bond to a different US corporate bond. On August 13th, 2020, Apple tendered $5.5 billion in bonds of several or multiple maturities. On its 5-year maturity bond, which is the same as MicroStrategy's maturity for the Bitcoin bond, it offered to pay an interest rate of 0.55%. In comparison, MicroStrategy's Bitcoin bond was priced at an interest rate of 0.75%. This means that the difference between the cost of financing Apple, the most valuable company in the world, and a bond to buy more Bitcoin is just a mere 20 basis points. Basically, Apple just saves 20 basis points or can borrow at 20 basis points lower than the cost to buy debt and hold more Bitcoin. Now, to get even more context, let's examine how the Bitcoin bond's interest rate compares to similar gold bonds and some other government bonds with similar durations. Now, as you can see from the graph on your screen right now, the Bitcoin 5-year bond is actually priced at a much lower interest rate than the 8-year gold bond offered by India's ICICI Bank. It is also significantly lower cost to borrow dollars to buy Bitcoin than it is to borrow dollars to fund the needs of the government of Mexico, for example, as we can see below. In certain cases, like the UK government bonds actually offer negative returns, which is a bit concerning because it signals that investors are actively choosing to get negative returns to hold these bonds. Central banks have recently begun experimenting with negative interest rates as they want investors to essentially put their money to work in other parts of the economy. Now, let's look at even some more comparisons for further context. Okay, so for further context, now that we understand what investors will demand in order to fund bonds to purchase more Bitcoin for 5 years, let's take a look at how much it costs countries to borrow funds to fund their operations. The most widely used benchmark for this type of country risk is the price of a government's 10-year bonds. Now, let's look at how the Bitcoin bond fares in comparison. Although they are different durations, and different durations will materially affect the risk profile of a bond, as a thought experiment, it is fascinating to see the rate of the Bitcoin bond at 5 years is really literally mere 20 basis points away from the rate investors get when they fund a US government's 10-year bond. We can see how close they are. Similarly, we can appreciate how the interest cost of borrowing to buy more Bitcoin through a US public company is perceived to be far less risky than funding the governments of countries like Colombia, Mexico, Brazil, and Turkey for 10-year terms. Bond market participants are known to be experts at pricing risk, and they have voted with their allocation to MicroStrategy's offering. The other point in this chart that deserves to be called out is how wildly different the borrowing costs are for countries in developed versus emerging economies. This has a huge impact on a country's debt servicing costs, but that would be enough to cover in an entire new segment, market trend segment. For now, we can safely assume that based on the success of MicroStrategy's offering, it won't be the last one. Perhaps the last one of 2020. Lastly, moving on to our Bitcoin mining difficulty commentary, we had a difficulty adjustment kick in last night, which brought us down to 18.87 terahashes, or down 2.54%. The Bitcoin mempool has been pretty empty as of late, so it's a good time to do some UTXO housekeeping. Not much more to report on this front, but we will keep you updated through our social media network accounts with any relevant info. Now, as always, we leave you with what's ahead for the week. It is a very important week for the U.S. This week, with vaccinations starting around the country. With vaccinations, expectations of the great reopening will also start increasing. This may lead to a euphoric 2021 spring full of economic activity and more stimulus. All of this is getting institutional investors thinking about inflation. M1, like we talked about, the amount of money in circulation, plus M2, rising monetary velocity, equals inflation. When that word gets mentioned these days, all roads and links lead to Bitcoin. We don't expect the MicroStrategy offering to be the last Bitcoin bond. And as Bitcoin treasury investment positions become more common and continue to outperform gold, the risk becomes to not own any. In not so exciting news, it is widely anticipated that there will be legislation introduced by the U.S. Treasury Department this week on the use of self-hosted wallets for American citizens. Articles abound of exchanges reporting the largest outflows in 3 years and the lowest BTC balances on exchanges since 2018. We hope that the proper thought, consideration to industry input, and legislative debate is given to this law before it is introduced. If this is not the case, we will work with our industry peers and groups to help move this legislation in the right direction. Lastly, Michael Saylor's future purchase of $650 million, along with the $500 million allocation from Guggenheim that it announced 2 weeks ago, continue to build a massive institutional buy wall for Bitcoin. To put things in perspective, Kraken trades about $200 million of Bitcoin volume average per day, and Coinbase does about $275 million in average per day. These allocations need to be fulfilled, and that puts a lot of upward price pressure on Bitcoin. As always, we'll keep you posted on any relevant information or news through the week through our social media accounts at Hodl with Ledin. And if you don't yet have a Ledin account, I invite you to check out ledin.io and check out how you can start earning 6.5% on your Bitcoin and 11.7% on your USDC. If you learned something today, I invite you to share, like, and subscribe. And have a great week, everybody. See you next week.